Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one of the UK-focused, actively managed collectives that sits within our new list of 72 favourite funds, namely Evenlode Income. The fund's mandate is to provide long-term total returns for investors with an emphasis on income. It seeks to deliver this by building a concentrated portfolio of predominantly UK stocks, although there can be some overseas picks too. The lead managers are Ben Peters and Hugh Yarrow, the latter having set up Evenlode back in 2009. They tend to focus on stocks capable of delivering sustainable growth with limited need for additional capital investment. Such scalable business models can mean there's plenty of cash left over once bills are paid, and that cash flow can ultimately be turned into dividends for the funds managed on behalf of you, the investor. According to the latest fact sheet, 82% of the assets are held within the UK, with 15% in the US and the rest in Europe, as we can see here. The biggest holding in the £1.3 billion fund is consumer goods giant Unilever, which is particularly topical as the FTSE 100 firm has just announced a new 6-point plan designed to boost returns for shareholders following the fright it received in the form of a tentative bid approach from American company Kraft Heinz. After that, the biggest positions are global drinks play Diageo, pharmaceutical firm GlaxoSmithKline, American software behemoth Microsoft, and then FTSE 100 accounting software specialist Sage. The other big US holdings in the top 10 list are health and hygiene player Johnson & Johnson and personal care company Procter & Gamble. The net result is a tight-knit portfolio of just 39 holdings, where the largest sector exposures are consumer staples, tech and healthcare. Interestingly, real estate, telecoms, utilities and energy, all sources of income for many fund managers, have no presence at all in Evenlode Income, as we can see here. Large caps currently represent just over 60% of the assets, mid caps just over a quarter, and small and micro caps the rest. The fund is eligible for SIPs, ISAs and dealing accounts, and currently comes with a yield of around 3.3%. Evenlode Income comes with income units where dividends are paid out, and accumulation units where they're reinvested for you automatically. On this occasion, we're discussing the income units where dividends are paid quarterly. The ongoing charge figure is 0.95%, so you do have to pay for the expertise of the fund managers. And for those who set store by such things, the fund comes with a 5-star ranking from Morningstar. So, those are the mechanics. The question to address now is, why could you and your fellow investors possibly consider this collective for inclusion in your portfolio today? I think there are 3 possible reasons. First is that 3.3% yield, which still handily outstrips anything available on cash, anything available from UK government bonds out to 50 years, any US government bond and any 10-year bond from a Eurozone government except those issued by Portugal and Greece. The second reason is the portfolio's makeup. Stable and able consumer staples, defensives, fell out of fashion in the second half of 2016 as the UK referendum and US presidential election results prompted a dash for the reflation trade, amid hopes for accelerating economic growth and inflation. President Trump's failure to push through healthcare reform, the risk of delays to tax reform, and the absence of big infrastructure plans from the budget blueprint all question the reflation theme, as does a slight ebbing in UK and US inflation. Any further such doubts could stoke fresh interest in more dependable earning streams, such as those on offer from portfolios such as this. The third reason may be historic performance. Now, we must accept there is no guarantee for the future from historic numbers, but Evenlode Income has built a good track record since inception in 2009, with fairly limited volatility, as this final chart shows. This may appeal to any investors who are feeling a bit nervous about short-term market conditions, or those who are seeking a long-term holding to help form the bedrock of their portfolio's income element. Now, this is not to say Evenlode Income may suit every investor's overall strategy, target returns, time horizon, or appetite for risk. There are certainly income funds out there which come with a higher yield, and passively run income funds which may well come with lower costs. In addition, the focus on the UK may not satisfy everyone, given the doubts which may persist in the minds of some about Brexit, and now the snap election called by the Prime Minister for June the 8th. This fund hasn't been tested by a bear market yet either, and there are always risks, whether they relate to the broader UK stock market or more specifically to the managers themselves and their process. As a result, you should do your own research before deciding whether to put any capital to work or not. So thank you for watching, and I look forward to seeing you next time.